in the final innings of the Chinese New Year of the Dragon, and what was mostly a lackluster year for energy prices looks like it's ending with plenty of fire. Oil, natural gas, and petroleum products have rallied hard in the final months of this auspicious year. To discuss this upside surprise and where we could go next, we are joined by Aldo Spanjer, Senior Commodity Strategist from BNP Paribas. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this is the podcast for you. Before I begin, I do need to state the following. To clarify, the views, opinions expressed in this podcast are those of Wisdom Tree and, in this episode, BNP Paribas, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not recommendations, offers, or solicitations to buy or sell securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So, with that compliance wording out the way, welcome Aldo. Please do tell us a little bit about yourself and the role you play at BNP Paribas.
Yeah, right. Good morning. Thanks for having me. So I said I'm a commodity strategist at the BNP since a bit over 2 years, which means I look after all the energy strategy for the bank, which means oil, gas, power, and carbon. And I look at it from a research perspective as well as from a trading perspective, which means I do the short term and the long term. I think, as you can judge by my accent, I'm quite Dutch. So I spent most of my professional career at Shell, where I was 14 years in different teams, different countries, but mostly on the strategy side of things, and mostly in gas and LNG, in oil, and in power markets. And before then, I came into Shell. It's always been energy. I did my PhD in Leiden on the regulation of the European gas market. So yeah, I seem to be in a job now where all the different strands come together in a single point.
Wow, we are very lucky to have your insights in our podcast this morning. So, as I mentioned in the intro, oil and natural gas both performed really well. Um, what have been the big drivers for oil's performance over the past month, and do you think some of those drivers will continue in coming months?
Yeah, okay. Yes, oil is interesting in the sense that, like you said, I would almost say very, very expensive. It came off a bit, but it's super expensive, particularly versus where people thought it would be 2 to 3 months ago. Because everybody at the end of the year, if you remember, was super bearish. Chinese demand was bad. OPEC supplies, everybody was expecting OPEC would bring supply back, and there's a lot of other supply coming into the market. I think what changed, and it's a lot of it is temporary, was that the end of the year was pretty good. In that, if you look at the US, refinery runs were quite high. They were burning a lot of crude to make products because the margins were quite good, better than expected. So they were running quite hard. Cold snaps are actually good for oil demand in that you really need a lot of diesel or gas oil to heat homes. That kind of helps. If you get freeze off, kind of an issue for prices in the sense that if it gets too cold, you can't produce oil. So also supply goes down. And it all creates a risk in the markets where people start to think, oh, actually, maybe price goes up, prices go up. So that's where we started. And that was before we had the Biden sanctions on Russia. So that came on top of it. So we already had the market that was, I would argue, temporarily a bit strong. Then you get Biden sanctions, which is actually quite tough. We can talk about them later. They're actually tough and broad, which means that the traditional off-takers of Russian gas, which right now is Indian and Chinese customers, they really need to find other barrels because they didn't really know whether they would still be able to take Russian gas, which means you buy gas from Dubai, oil from Dubai, you buy oil from Europe, which means prices go up. So we got a bit of a perfect storm, I would say, almost, of strongly bullish drivers. I do think coming from a temporary. With the Russian sanctions, depending how the off-takers deal with it, that's kind of a structural thing. It will become more difficult. but the weather impact goes down. With high oil, you also see margins in refineries go down. So Asian margins, basically the money an Asian refinery makes, has plummeted. And that's because their oil is expensive. So I do think you're going to see the demand upside come down quite materially. Again, it won't stay cold forever. And the last point is we're going to take a lot of capacity in the US and Europe in maintenance. And if you start to maintain your refineries, they don't run. If they don't run, they don't need oil. Oil demand comes down. So I do think the pressure will come off, but the start has been extremely strong. Fair enough.
So the Middle East conflict was supposed to have put a geopolitical premium into oil. Um, However, since the Israel-Hamas ceasefire, we haven't seen much decline in oil prices. Is that geopolitical premium actually there in oil? And is there a reason why prices haven't come off so much since that ceasefire?
Yeah, that's a good point. No, I think the explanation is that the premium is there, but it was already priced out. Because I think if we look at the Middle East crisis, been a pretty long route, a couple of months in terms of just de-escalation.
Hmm.
So I think when we looked at basically mid and late last year, you could really see the moment this conflict was aggravated, you saw between $5 and $10 added to crude. So to me, the premiums it's clearly sits between $5 and $10, but it's been pretty quiet for months. So this is why I think that at the moment you saw the actual ceasefire spike, it was already priced in because everybody saw this coming. What I think is interesting is for me, in my base case, the premium is zero. I don't have any upside to crude structurally from the Middle East, but I am aware that we're one headline away from another $10 upside. If there's one bad headline, and I mean, I'm not expecting it, but it could happen, it's another $10. And I think that's probably going to stay with us for a while because I think the Israel-Iran issue has not been resolved quite yet. So it is, but right now I agree, it's not in the price at all.
Yeah. So you mentioned the increased sanctions on primarily on Russia, but a number of other countries that had led to that increase in oil price earlier this year. But we know that newly elected President Trump wants to get President Putin of Russia, to the table to discuss the end of the Russia-Ukraine war. Um, do you think he will apply more sanctions in addition to those Biden sanctions a couple of weeks ago to get in there? And what do you think that will do to prices?
No, he could well. I mean, he said it yesterday, effectively, because I might need to do more. Look, it's too early to tell because if you look at the current sanctions, the Biden sanctions, for lack of a better term, they really kick in at the end of Feb, basically, because there's a grace period in the sense that they said we were going to sanction ships in currents, flows, fruit producers, but anything that's on the water today is okay till F27. So that kind of means that the real disruption in fiscal terms, if it happens when everything is basically done, when the grace period is over. What you're seeing now is buyers being nervous about the ability of not being able to buy Russian crude. So Chinese and Indian buyers, they really bid up crude and Dubai grades, which makes sense because those are the alternatives to Russian. And you really see prices come up, in particularly the March window. So the question on whether you tighten it, look, if nothing happens, but I do think that these sanctions are negotiating chip exactly in the Russia-Ukraine peace deal. If nothing happens on the Russian side, I think you're right. You might actually have to tighten them further and just basically force Putin to the table. I think you can only tell whether they are tight enough and whether it would hurt Russia enough, I guess, to get Putin to the table when we are in early March. Because then we know, one, all the oil is actually being pumped. There's no grace period anymore. And we also know whether the off-takers and maybe the suppliers, whether they found workarounds. Because it's a specified number of ships that's been sanctioned. It's a high number. It's not easy to replace. But we have seen movements already of Western-oriented crude vessels being diverted to the east, where the issue, of course, sits with the ESPO grades. So if they manage to find a workaround, the impact is very small, and you might actually need a new round. So I think the risk is very much there. I don't think you're going to see it before March. And what it would do to price, the moment people think that we're going to have physical disruptions in Russian supplies, Brent crude goes up. I think that's clear. We have to an extent priced it in because we came up quite a bit. Again, if I'm right, I think we're going to go off in February on maintenance and all that kind of stuff, demand coming off. You might actually see another leg up again in March then if we then start seeing the disruption to really materialize.
Yeah. So, speaking of Trump, in his first few days in office, he's been talking tough on tariffs. Maybe not as tough as many had expected, but 25% tariff on Canada, Mexico, maybe as early as first of February. Um, what what implications do these tariffs have on oil prices? I mean, there's a considerable cost border flow of oil and gas from Canada and the US. What implications do you think that will have on prices?
Yeah, that's a good question. That's where do you think they're going to go through? So maybe
Yeah.
the place where I start is exactly your point, is that both Canada and Mexico are quite important for the, more than quite, very important for the US energy system. If I look at their exports into the US, if I add Canada and Mexico up, we're 4.5 million barrels of oil that's imported into the US, with 30% of imports from the US and probably 20% of demand. So the main place, if you start anchoring with that, you really hit, because I think the retaliation will then be on energy as well. You kind of hit 20% of your imports, but there's no way that's buried. So I think that's actually a big problem for particularly the refiners in the Gulf Coast. Because what it does is, if you have sanctions on crude prices will go up. The WTI and all these trades go up. It is more expensive to run crude. So refiners have to pay more for their crude, which kind of means your product, the gasoline, the diesel you make, would also need to go up. But we know Trump's quite sensitive to to gasoline prices. So this is a big issue for refiners. I think you're going to see significantly higher crude prices into refinery. I'm not quite sure I'm going to see higher product prices out of a refinery, which means margin compress, and they might run less. And this is exactly the reason why I think it's a hard one to see. If it happens, it's very bullish. The runs go down and crude strongly goes up. I don't think it happens because of this. And the other point with Canada, we'll get to gas in a minute, but Canada is not important in gas in the sense that we've got like 6 BCFD net imports, so basically imports minus export, exports Canadian minus imports from the US. 6 BCFD, which is more than 5% of US gas supply. It's a time point. And of course, US gas demand will go up quite significantly because of the LNG terminals that are starting to ramp up through 25 and 26. They need all the gas they can get their hands on. So add these two up. If there are tariffs, I, I, I find it difficult to see that energy is going to be targeted because you're shooting yourself in the foot. And I see both of them as negotiating border issues.
Yeah.
So I think in the end, you're not going to see them for these two reasons. It's just a known goal, and I think it's quite clear what the bigger deal here is.
Yeah.
But of course, the market, because I need to look at the market as well. The moment you see signposts of this, you kind of have to. You have to become bullish on Henry Hub. You have to become bullish on TI, because there is a risk. It's a non-zero risk that it happens, and then prices will shoot up both crude and for USF.
Yeah. Yeah, no, I agree. I think it is very much a sort of a bargaining ploy, but yeah, there is always that risk that something an accident happens, right?
Yes, I
um,
agree.
so speaking of Trump, in an extremely busy week since his inauguration, he announced a national energy emergency. Tell us a little bit more about that and what it means for the U.S. oil and gas market.
Yeah. So what it does is It's hard to define because it's actually not a well-defined term, emergency declaration. But what it at a high level does is it allows the administration more power to force things through, effectively. That's the short one. If you look at energy, it allows you to do more while, for instance, paying less attention to pollution constraints or environmental constraints. So if what you could do in terms of power, you could basically mandate power plants to run max, to run baseload as much as they can, without the downside, without factoring in the downside that pollution levels will probably go up, particulate emissions go up, and air quality should go up. But the production is basically being prioritized over that. You could, for instance, also force more gasoline production. If you really want to have gasoline prices down, which is always the tentative need in US politics, you could mandate refiners to make more gasoline. They need to run more, they pollute more. So it's basically you can override, and I'm using pollution as an example because I think that's the big constraint here. You can override these kind of constraints because you want more production. So I think that's where the impact probably sits. But my point is, if I look at oil and gas, this is all existing production. It's already there. You just run harder with what you already have. Fine. What people are looking about now is, can he actually force more new production? Can he basically force more the whole drill where we drill mantra effectively? Can we actually use that to basically get more oil out of the ground and more gas out of the ground? Look, that's where I become really quite conservative. So again, in my balances, I'll be honest, I have zero incremental increase over what I already had. I have growth, 300 KBD for US oil. I'm not going to make it higher. The reason is, what you can do here is, you can open new acreage. That's a measure. You can probably facilitate pipelines, and you can probably cut red tape like the administration wants to do. If I look at all three of them, cutting red tape is a good thing to do because it lowers your break-even price for upstream production. Maybe you can produce the lower price. That's not something that happens in a week. I think that's quarters, if not years out. So I think that's, to me, definitely not a 25 story. That's something that comes later. Pipelines, same thing. Pipeline capacity is an issue in terms of basically importing to Canada, but also producing and bringing it to the demand centers. If you can do that better, that's a good thing long term for production. Again, building a pipeline takes years. So also that's, I think, is very much backloaded into his term in terms of impact. And then the last one, maybe the one with the biggest near-term impact, is acreage. But if I then look at where you can basically drill, it's Alaska, it's Hill, and it's probably the Gold Coast. I mean, those three are the big ones. Alaska, I think it's not economic. I think it's quite hard to see the numbers work on that one. So you can open acreage, but if it's not economic, it's not going to work. Gulf Coast, or the Gulf of Mexico, sorry, fair enough, but that's deep water. That takes a long time to drill. So there you go again. You again have a very long period between instigation and production. So again, I don't see it in 25 or 26. Still, I can see, because it's quick production. Still, you can do it in 9 months. So there you could potentially have an impact, but still there's no shortage of acreage. So I think still producers should probably finish the current acreage or use the current acreage before they really need new acreage. So if I add that up, it's kind of hard to be very optimistic on seeing significant new production coming into the market soon on these kind of emergency declarations. We'll try, the message will be there. But in the end, it comes down to private players. Do they have the incentive to produce, to drill and produce? That's the risk. So if WTI, which is the West Texas Intermediate, so it's the biggest US crude grade, if that's too low, and you want lower prices, that's the other part. If that's too low, it just doesn't make sense to drill and produce. So my mental model here is, if the price in the US stays above $65 for TI, you kind of have a production incentive and you will produce anyway. If you get below 65, new acreage doesn't make money, and you can do whatever you want on the facilitation side. It doesn't really matter because there's no production incentive. So for me, it becomes a price story. And then his whole target of having lower prices, you can't push it too far, because if I bring the local prices down too far, I can almost guarantee you there will not be production. So it's a difficult one. I see it more than things will happen, but if you really go down to the detail, it's all about price. I would look at TI before any any measure out of the emerging declaration, to be honest.
Yeah. Wow, that's interesting. I guess another area really worth discussing is OPEC's production restraint. That's in play till April, but they plan to unwind some of the restraint starting in April. What's your views on that? Do you think they will unwind at that point, and what impact do you think that will have on both balances and prices?
Yeah. Yeah. So before the tariffs, this was the key point. Anywhere in the market, all the other stuff. If I look at last year, all the clients I've spoken to and see where I get most challenge, it's OPEC. Because our call here is OPEC does nothing, and I'll explain it in a minute. So they basically said what they've done is they've reduced supply because the market was super weak, and everybody's waiting for them to bring supply back. Our stance on that is effectively, if the market is not strong enough, I don't see the incentive for them to bring anything back. And the market not being strong enough is basically if I price Brent in the low 70s, if I start bringing supply back as OPEC, you're in the 60s, for sure. And that's in no one's interest. That's been the call for the last 6 to 9 months. That's what I've gotten by far the most challenge on. The market is really in a different place. I don't think I should change it. So it basically means that they roll over the cuts in Q1 makes sense because the first quarter is usually quite weak with all the refinery maintenance we talked about earlier. I don't think Q2, the second quarter, is going to be particularly pretty. I think you're going to be at the mid 70s. I mean, if you need a price target for me, so like 75 for Brent. If I then still start bringing OPEC back again, I go to 65 probably, something like that. And it's not in the interest of the cartel. They need higher prices, not lower prices. So I do think, and again, there's a few exceptions to the rule, and I'll get to that. But if everything, all else equal, I honestly think they roll over again through the entire second quarter, which is a difficult thing for them to stomach. But I simply think the alternative is of bringing oil prices back to 60, and they don't get any upside in terms of market share because all the other suppliers, the non-OPEC suppliers, are still there. So that's where we are, at least if we recall, very much out of consensus, I would say. What changes the needle is these sanctions. So the one scenario where I could see OPEC actually bring supply back is if you get the Russian sanctions, let's say they can't manage around them by the end of February. Let's say we then see strong disruptions in March, could happen. And we need to talk about Iran. That's the other one where I'm quite convinced we're going to get sanctions on Iran. If they come on top of it, I mean, you take out at least 1 million barrels, probably 1.5 million. If that happens, you're at 90, $85 to $90 crude. Of course, OPEC comes back. So I call it over-tightening. If we go into this kind of over-tightening situation, so both things that hit at the same time and they both hit hard, yeah, of course, OPEC comes back and prices would probably have to settle down somewhere in the 80s. But I don't think we're going to get both sanctions at the same time, as we talked about. I think Russia goes out for an Ukrainian peace deal. Then I think Iran ratchets up in terms of sanctions. I never get into these super tight markets that justify 90 plus euros per dollar a barrel. In that world, I think it's too costly for OPEC to bring supplies back, and they will roll over. But of course, the narrative will be, and it's so interesting. So this is the fundamental perspective. You saw it yesterday in Davos, right? One sentence from Trump is that I'm going to force OPEC to lower prices. He can't, but I mean, it's clearly the message. See what happened to Brent. It massively sold off. So it doesn't mean that this whole narrative is not going to have an impact on the market. I think it will. The moment this comes out, that OPEC, the closer we get to April 1, the more downside you're going to get because people start pricing in the OPEC volumes again. If then it turns out that by April 1 they still roll over again, you're going to see a bit of an upward adjustment again. So volatility is probably going to increase.
Excellent. Well, why don't we shift gears a little to natural gas? U.S. natural gas had an extremely strong start to the year. Was that all weather related, or was there more to it?
Yeah, US that makes me laugh because it's just over a year back. Let's see where we were. So it's a year back we were insanely bearish, and now we're very very bullish. A
Yeah.
lot can change in a year. And a lot of this is weather, but I think it's partly weather and partly structural, maybe even normalization. And that is why I go back to like a year ago. If you go to February, March, we priced Henry up in 24. We priced Henry up below 2, which is that price, I think is sync breaks in the US. So it's not really okay. Existing production doesn't even work. And the issue in the US is it's a complicated market. You have a big chunk of gas out of the Permian, which is Texas and Louisiana, that comes out with the oil. It's allocated gas. So if oil is expensive enough, that gas will always come out. So I'm not talking about that gas because that's the oil prices, not the function of gas prices. I'm talking about the gas that's in the Northeast that just comes out without the oil. They need a sufficiently high gas price to make it worthwhile to produce your gas. And there the point will be below 2, it just doesn't work. Even existing wells don't work, let alone drilling new ones. Everything breaks down. And that's what you saw last year. We went below 2, and the reason we went so much below 2 is 2 warm winters. We had 2, I call them El Nino. I think we were lucky once and we had El Nino once. A warm winter is really bad for gas demand because gas demand goes into heating. Gas demand is low, you stockpile because production doesn't always adjust day on day. So we started 24 with historically high stock. And what I mean by that is the actual stock level in gas was massively above the 5-year average. That means you get oversupplied. And if you oversupply, you kind of need to put in production and increase demand, and that's where prices go down. It hurt like a drum because if you're at 2, demand really went up. Suppliers had to curtail existing production. So no growth, you actually eat into existing supply. That's how we balanced through the year effectively. Supply was low, demand came up, and then we started to eat into the overhang. And then winter came. And then we had a big cold snap, and a cold snap is hitting. So the demand really, really came up, and it ate into that overhang much quicker because supply wasn't quite there yet than people thought. And that's basically why Henry Hub really saw a strong increase in like end of Q4, particularly early Q1. On top of that, LNG started to ramp up because you had one of the Plaquemines terminal, which is the first of the new LNG terminals that's basically ramping up. What these terminals do is they need gas. So they basically need to buy gas off the grid and then liquefy it and then hopefully send it to Europe so we don't pay too much for our own LNG. But it basically needs new demand. So you get a cold snap, high demand in power gen, and basically new demand in the form of LNG that really eats away at the overhang. So my target, just to give you a number, one was about 3.5. And I think that's normal price. If below 3, I cannot see the new production come into the market, the new dry gas, as it's called, for the stuff that doesn't come with oil. So you can't go below 3 in my mind. 3.5 is more or less what you need. We went to 4, and that's, I think, the overshoot from a relatively cold now. So we're not far from where I think we should be. Maybe that's the point. I think it comes up now because Q2 will be warmer than Q1, so the weather upside comes down. But I think Henry Hub is on an upward trend because of more and more LNG demand coming into the system, and we need to find new gas to basically supply all these terminals. And it won't be cheap gas.
Ah, that's very interesting. And I guess we've seen similar, or if not more spectacular, increases in European natural gas. The title transfer facility prices rose. We started the year with the Ukraine-Russia pipeline deal coming to the end. We had a cold winter, which was which we didn't have for the last 2 years. And so stocks of European natural gas have been coming down. Do you see that lasting? And what are the complications do you see in the European natural gas market going forward this year?
Yeah, yeah. And I said oil was difficult. I mean, EU gas is by far the most difficult one because I'll explain in a minute. You could almost conceivably say the market is broken. And it's a huge problem. So basically, the reason we are so expensive today, I mean, that's kind of understandable. is that you're right. So we had, again, 2 warm winters, which is really quite comfortable. Now we're in a normal winter, because I don't even think we're in a cold winter. We're in a normal winter, but year on year, this winter, it's massively colder. And again, a cold winter means high demand. So we have been a little bit surprised by the demand increase here because we need to heat our homes. The other issue is that not every country in Europe filled their stock to the target level. Because look at the target. Because of the after the crisis in 22, the European Commission basically said, we can't be short gas because then prices explode and everybody loses. We need to basically have a pathway towards decent levels of gas in storage because that's the buffer for winter. Okay, fair enough. That number is 90% by November 1. So the stock needs to be 90% full. Every country has its target. Most countries reach. Holland was below, so my own country. France was below. So not everybody floats towards the level, which means to start already on November 1 when winter starts at the lower level. Then draws were higher. What it does is, and Russia went out. Those are the three big boys. So what it does is people are already worried about, okay, weather is colder. B, I'm seeing my export stock levels lower than last year. So those are 2 things to worry about. And I've got less supply to deal with this because Russia went out. All 3 bullish. So that kind of explains why your first quarter could be quite expensive. I was at 45 and it's actually gravitating. Here was the megawatt hour and it gravitates between 45 and 50, more or less, where we are. So again, it's expensive, before. It's all right. It's not completely out there. I still think it's within a reasonable range given the tightness of the market because there's not enough new energy yet. What would really worry you is summer, so Q2. So if I look at the second quarter prices, I haven't looked this morning, but they're 4 to 5 euros above the winter price. And the whole point about the European gas system, any gas system almost, is that summer demand is low. In summer, you fill your storages because you need them in winter when demand is high for heating. To do that, you actually need a lower summer price than a winter price. Because why would you summer? Right? You want to buy cheap, sell expensive in winter. That's why people fill a storage. Now it's opposite. It's inverted. You would buy expensive in Q2 and you would sell it cheaper in Q4 when the winter basically hits. So that's what I mean. The market is broken. If this stays, there is no incentive to store. Because why would you do it? You're losing money effectively. If you don't store, kind of have it's a next winter. Because if you start then too low and you get a cold winter, you might run out of reserves. So this is the issue. It's not today. It's Q2. And this needs to settle down. And look, I mean, our forecast for this one is the reason Q2 is starting is people think we're going to draw too much storage in this quarter by the end of March. And they're right. If you really think you're going to draw to like 30%, I'm at 37, just to give you a number. But if you're much below it, or cold winter, you need to fill so much in summer that we need to buy all the LNG we can get, and that pushes up prices, right? So it kind of makes sense. I still think, and this is a fundamental view, that this is worse than last year. It's not a disaster quite yet. If we don't get a big, massive, larger than average cold snap over the next 2 months, so by till the end of March, I think the storage levels will be lower than last year, but still okay. If that happens, you kind of have a pathway towards end of March into 1st of November to fill your storages. And I think the moment the market is somewhat comfortable that we can fill to the level, you don't need summer at 45 to 50. It really does. And I think now summer goes down to 40, which is high, but that's kind of where we need to be to attract all the LNG we need out of Asia. And that winter goes up a little bit above that because I need to have the summer storage, which basically means summer will come off. The big risk here is weather. Look, because I can almost guarantee you, if we get a February cold snap, like we had in like 2018, I think all bets are off. Really is. And then summer will be very expensive. No one will fill in summer. And we saw now Germany, was the day before yesterday, 2 days ago. The German operators say, actually, we need to incentivize fills into our storage. So they're basically thinking about the capitalist team in saying, we think it's senseless, because I agree, because the spread is inverted. We're going to subsidize the delta. What that does is, it's kind of an issue for me, as looking at the market, what it does is it actually makes you comfortable that people will pay these high summer prices. So there's no reason to price summer down. So it actually retains strength in the market. So this is a very difficult one. And the reason I think this is so difficult to see is that as long as you can build in a cold snap in your fundamentals, you're not going to be comfortable about Q2. I think it's simple. So that means January, February, even if the balances look better, which I think they will, because LNG is being diverted into Europe right now because it's so expensive here. I think only by the time you hit March, and we maybe are confidently comfortable that the end of winter storages are not epically low, I think that's when the summer premiums should come off and then create a little bit of a spread towards winter and then hopefully create storage incentive. And the last point I'll make is if it doesn't happen, that's a disaster. So let's say it doesn't happen. I'm wrong and summer stays really expensive. Let's say Germany doesn't subsidize the storage cost, then you get that very late fill. So you will not buy gas in Q2 because it's too expensive. Maybe you buy it in Q3, but then you buy your storage way too late, which means the end when the winter starts next winter, you're probably going to have too little gas in storage, or you have to buy it very expensively, which means next winter is expensive. So if we don't solve it now, it's going to be expensive summer. It's either going to be expensive this summer. If that stays, I guarantee you it will be very expensive next winter. And that's what I mean by the market is a bit broken. These incentives are inverted, and that's a huge problem right now.
Well, I guess the broken market does provide a bullish picture for next winter.
It might
Yeah,
actually.
yeah,
Look, if we solve it's fascinating to see what happens now. If the German plan goes through, let's say they will subsidize storage fills, you're probably bullish summer, bearish winter, in that it kind of substantiates it provides a buyer in the market that's willing to buy at a high price because they'll subsidize the delta anyway, right? Up to a certain level, which means the summer can stay expensive. If you're still in summer, you kind of de-risk winter. So if you get this kind of government mandated system, you probably remain strength in summer and you probably see downside to winter, which of course aggravates the problem, but at least for next winter, it might actually make life a little bit easier.
well. And I guess returning back to U.S. policy, President Trump has indicated that he's disappointed that Europe's not buying enough of its LNG. Um, Obviously, Europe could do with more energy. What can Trump do to strong arm Europe to buy more? I mean, it's a difficult situation, right? None of the players are state monopolies, and we're not working on purely bilateral contracts. What can be done to maybe encourage extra consumption that Trump is seeking?
Not much. Um, Look, and the reason I'm saying not much, as I said, Europe already needs almost all the LNG it can get for and the way LNG tends to work is eight private operators. So these terminals, when they come online, they're going to run as much as they can because they basically contracted their cargoes anyway. So they run on contracted supplies already into Europe or into Asia. So whether it goes into Europe or Asia, it's a price effect. And whoever pays more probably gets the cargo because they're quite flexible, the ones from the US. So that incentive is not something Trump can influence. The only thing that influences whether Europe takes LNG or not is price. Like now, TTF is kind of a premium over JKF. And LNG comes to Europe. It inverts. If it gets very cold in Asia, it inverts and it goes to Asia. So particularly for gas, I see very little influence in these kind of messages. Europe already buys as much as they can. The terminals will produce as much as they can because that's how they make their money. There's nothing else you can really do aside from what we discussed. But that's a very long-term thing, maybe on the upstream thing. But particularly for LNG, I see very little upsides. The reverse is not really happening, which is a very, very high number of LNG imports into Europe anyway. So to me, that's something that it doesn't change my fundamentals at all. Again, maybe I'm putting place price. If Europe pays enough for the LNG, they get all the cargoes. And that's exactly what we're seeing happening in Q1.
Yeah. Excellent. I mean, so you've gone through many of the moving parts in the global gas markets, and US and Europe primarily. So, bring it all together. What are your TTF forecasts for the end of the year, and Henry Hub and JKM forecasts? So, where do you think it all goes? I know it's all a lot of moving parts, but what are you putting down on your spreadsheet?
Yeah, look, I mean, I need to say, I mean, gas is difficult, but it's as I said, I still think that the summer, again, when I say summer, I mean Q2, so not the whole summer. So the second quarter, I think, comes down materially because I don't think balances are that bad. I mean, they're not good, but they're not horrific. Which means my target for Q2 is 40 euros a megawatt hour, which is literally 9 euros lower than where we are today. So it's a step down, but I mean, I think it can happen. Which basically means I do think the spread to winter is positive, but low. So my winter price is literally 42. It's a little bit above on average, I'm talking quarterly averages here. It's a little bit above the summer spread because I do need the spread to incentivize my storage levels. And I think this winter, because the market is quite tight, because LNG is ramping up, it's not quite there yet. The market is tight. I do need these mandated storage fills. So I do need to get to 90 to be comfortable through the next winter. Otherwise, we get the exact same problem again. And no one wants that. So that's, I think, the European gas side of things. If I look further, so into 26, I become a bit more, I guess, optimistic on balance and pessimistic on price. In that in 26, I can comfortably see much more LNG coming into the market. It's mainly US. It's all the US terminals. They're basically building them as we speak. They're all quite kind of delayed because it's difficult to build an LNG terminal. But I think by the time we hit like Q2, Q3, 26, I think most of them are probably operating. If I then add up the numbers, just new supply into the market. If I add up all those numbers, there is enough to satisfy demand, which basically means the premium currently paying to come down. So I really think there's significant downside pressure towards the back end of 26 in European gas. The opposite applies to Henry Hub, because what we talked about is you need Henry Hub gas to make this LNG. So when I say there's a lot of LNG, EU and Henry Hub go opposite. So EU goes down because we get the LNG. Henry Hub goes up because they make the LNG. So I'm quite bearish, quite bearish TTF on this LNG coming in, and I'm a bit earlier, basically Q2, Q3, than what the market is pricing in. I think the market is pricing it in early 27. I think it's too late. So in that sense, I'm bearish for 26. I'm very bullish on Henry Hub because of this, in the sense that it should worry you that we hit 4 in Q1 on a cold snap in a market that's long, because we still were at stock levels above the 5-year average. When the storm is ramping up to 2026, we won't be long. I think we're going to be short in the US. And that means that these kind of movements upwards, when it gets cold and there's a lot of feed gas demand, I think it's going to get worse. So I do think Henry Hub by the year end is around 4 to 4.5, which is a bit above current. But I really think that in like Q2 26, I think it's peak. I'm comfortably going 5 to 6. This is very high. It's very much above where the curve sits. And the reason is basically the market will be, in my mind, 400 BCF short, which is really short. And this is a technical point, but it's important, I guess, the price is flexibility is not high. In the sense that the moment you fall short, I don't quite see where you reduce demand. Because it will be a winter, which means heating demand is kind of firm. Power demand, I don't have a switch to coal, which we used to have in the old days, which was nice, because you run more coal, less gas. Can't do that because there's not enough coal. And industry, you don't really want to constrain it because we saw what it did to Europe. So that kind of means that demand is not profitable. And then from an economic perspective, if demand is inflexible and you're short, what happens to price, it's going to have a pretty violent response. So I think we're going to see a short-term tight period in the US because the market tightens as demand ratchets up, LNG, and supply needs more time to catch up with demand. there is enough supply in the US. I just don't think it perfectly matches the demand profile. It takes longer to get supply online than it takes to regulate demand, which means I see a spike in Henry Hub like stakes in Q2 at the end of 2024 because there's enough fixed movies. So the moment supply catches up with demand, I don't think you need to be massively bullish for Henry Hub. I think 4 is a reasonable price. The last point is not all actually going to because all the LNG starts to really flow, and that I think it really changes the market. The last point I'll make is, and this is a good thing for Europe, is that if you look at TTF right now versus Henry Hub, just to pack them, you're probably at like a premium of $9 to $10 MMBTU, which means Europe is massively more expensive in terms of energy costs than the US, which of course really hinders industrial demand, right? And this is why I think Europe is in such a bad state. I think that premium very significantly erodes because Henry Hub goes up and TTF goes down. My premium goes to like 4. It's very low. So when I say that basically Henry Hub goes to 4 back in 2010, I've got TTF at $8 MMBTU in 2026. The premium is always going to be there because you need to make energy, and that costs money. But that premium massively, to my mind, it deflates, which is an upside on the economic situation in Europe. So I think there will be a lifeline for European industry because I think energy inflation just really tapers off. It's just not 25. 25 remains tight. 26, particularly towards the back end, I think the market lengthens and you're going to see a significant downward step below for TTF because $8, I mean, that's $5 an MMBTU below where we're today. It's a massive step down. And that's what LNG does for you.
Wow. Thank you so much, Aldo, for sharing all these valuable insights with us. Please do let our audience know how they can read more of your material and follow you.
Yeah, look, the material is, of course, all bank-related research, so that's kind of proprietary to BNP clients. They can also follow me on LinkedIn, where I tend to put these kind of things, podcasts and all the interviews I do. I like to put on LinkedIn so that everybody can follow that. So that's probably the best place to look at publicly available user data that I might be able to share.
Excellent. Great. Well, thanks everyone for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you do want to hear more from us at Wisdom Tree, please do subscribe on whichever platform you're using. You can follow me on X, formerly Twitter, with the handle at Nitesh Shah WT. And if you want to learn more about commodities, please visit Wisdom Tree's website, where you can find a wide range of research material and insights. Until next time.